What if I told you the biggest hurdle to building wealth isn't the stock market, but actually your own brain? Welcome to today's Explainer. We're diving right in because today we are looking at a true masterclass blueprint for building long-term wealth. We're going to break down how to master market mechanics and honestly, more importantly, how to master your own mind. If you've ever felt completely overwhelmed by the nuts and bolts of investing, this is going to bring everything into sharp, actionable focus for you.
Before we get started, I want you to honestly ask yourself, what is your absolute biggest enemy when it comes to investing? Is it the crazy volatile market? Is it those sneaky high management fees? Or, as we're going to uncover a bit later, is it actually your own psychological biases? Keep that in the back of your mind as we map out this journey.
So here's our roadmap for today. 1. The magic of compounding. 2. Building a diversified portfolio. 3. Doing your own research. 4. Overcoming those tricky psychological investing traps. And 5. Staying the course long-term.
Let's jump right into Section 1, the magic of compounding. Time is literally your superpower here. Have you ever heard of the Rule of 72? It's this awesome, super simple mental shortcut. If you want to figure out exactly how long it's going to take for an investment to double, you just divide 72 by your expected annual rate of return. So let's say you're getting a 10% return. Well, 72 divided by 10 is 7.2. That means your money completely doubles in just over 7 years. And you didn't even have to lift a finger.
To show you how that actually feels in real life, let's look at the 8-4-3 rule over a 15-year stretch. For those first 8 years, yeah, you're just laying the foundation. Honestly, it feels pretty slow, kind of like pushing a boulder uphill. But then it takes only 4 years to see that exact same amount of growth again. And finally, just 3 years to replicate it completely. Compounding starts out like a really slow snowball, but give it time and it triggers this explosive, totally exponential wealth growth.
But, and this is a big but, there's a silent killer lurking in all this compounding: fees. Imagine two different investors. They start with the exact same amount of cash. They both get that same 8% return over 30 years. But investor A pays a 0.1% fee, while investor B pays a 0.5% fee. Well, looking at this over 3 decades, that tiny, seemingly harmless 0.4% difference literally cost the second investor over $1 million. $1 million. So yeah, absolutely always keep an eye on your fees.
Okay, moving right along to Section 2, building a diversified portfolio. This brings us to what's known as modern portfolio theory, or MPT. And hey, don't let the fancy math terminology scare you off. The core idea here is actually super intuitive. It basically says that you shouldn't judge an asset's risk in a total vacuum. Instead, you have to look at how it impacts the stability of your entire portfolio. It's like a giant puzzle. It's all about how the pieces fit together to give you the absolute best return for the level of risk you're actually comfortable stomaching.
So what exactly are those puzzle pieces? Well, you want to spread your capital around across essential asset classes. We're talking domestic and international stocks, reliable government and corporate bonds, inflation-linked fixed income, and even real assets like real estate. By mixing these all up, you essentially neutralize the specific risks tied to any single company or sector. Basically, if one area takes a huge hit, the others step up and act like a cushion.
Now, what does a modern diversified portfolio actually look like? Traditionally, you'd always hear about the classic 60-40 split, 60% stocks, 40% bonds. But with modern economic shifts, especially with higher inflation, a lot of experts are now suggesting you carve out about 10% for real assets or alternatives. That leaves 60% in stocks and 30% in bonds. This kind of setup gives you a really solid, reliable balance between aggressive growth and protective income.
All right, so once you know what to buy, how do you actually go about buying it? You basically have 2 main strategies. First is lump sum investing, which means putting all your money to work right away. Mathematically speaking, since markets generally trend upward over time, lump sum usually wins out. But then there's dollar cost averaging, investing a set amount every single month. This adds some incredible psychological discipline. It smooths out the bumpy ride so you aren't completely terrified if the market suddenly drops the day after you put your money in.
Next up, Section 3, doing your own research.
You'll hear the term DYOR a lot, do your own research. This is absolutely crucial. It's the critical shield you need so you don't get blinded by all that crazy hype on social media. First off, you gotta understand the fundamentals, like what does the business actually do? Second, dive into those financial statements to check on their revenue and debt. And third, assess the management team. Who is actually steering the ship?
And when you're looking at those financials, watch out for a major red flag, a single point of failure. Think of it like this. If you're researching a sports equipment company
and 90% of their revenue comes purely from selling footballs, well, that is incredibly risky. I mean, what if the demand for footballs just completely drops off? You want to see diversified revenue streams. Footballs, basketballs, yoga mats, the whole shebang. You want a company that is just as diversified as your own portfolio.
Let's pivot to Section 4, Overcoming Psychological Investing Traps. Now, we really have to talk about behavioral finance, which is kind of the final boss in this journey. Let's start with loss aversion. There's this concept called prospect theory, and it reveals that humans have this deep-seated, totally irrational aversion to losing. This is exactly why you'll see people stubbornly holding onto a losing, depreciating stock for years. They do it simply because they want to avoid the psychological pain of actually clicking sell and making that loss real.
If you've ever felt physically sick to your stomach during a market dip, guess what? Behavioral finance completely validates you. Psychological studies actually show that the pain of losing money is roughly 3 times more intense than the joy of making that exact same amount. Your brain is quite literally hardwired to panic when the market drops. But hey, just recognizing that fact is the very first step to beating it.
And of course, that panic leads directly into our next trap, herd mentality. It's the classic bandwagon effect, driven entirely by FOMO, the fear of missing out. Herd mentality causes people to just blindly follow the crowd. And what happens? They end up buying in at these euphoric, super expensive market highs, and then they panic sell at devastating market lows, which, as you know, is the exact opposite of what the math says you should do.
So the big takeaway here is that you have to actively avoid these sabotaging behaviors. For sure, do not let overconfidence trick you into day trading. And please stop checking your account balances every single day. Seriously, it only breeds stress. Limit your exposure to all that media fear-mongering, and whatever you do, never blindly copy a friend's strategy. Their risk tolerance and their end goals are going to be completely different from yours.
Finally, Section 5, Staying the Course Long Term.
Whenever you feel that overwhelming urge to panic sell, I want you to remember this simple ratio: 8 out of 10. Over the last 35 years, and we're talking through major recessions, the dot-com crash, global crises, everything, the U.S. stock market has posted positive annual returns in nearly 8 out of every 10 years. History absolutely favors the patient investor.
Plus, staying the course unlocks what we call the dividend advantage. Did you know that more than 30% of the S&P 500's total historical gains didn't even come from stock prices going up? Nope, they came purely from dividends and reinvesting them. By just staying in the market, you capture all of this beautiful automated compounding. If you try to jump in and out to time the market, you're going to completely miss out on those vital dividend payouts.
So how do we keep our emotions totally in check? We rely on a mechanical process called portfolio rebalancing. Basically, once a year, you just sit down and review your target allocation. Let's say your stocks had a massive year and now they're taking up way too much of your portfolio. You identify that drift, trim off some of those winners, and use that cash to buy more of your underrepresented assets. Rebalancing naturally forces you to sell high and buy low, taking human emotion completely out of the equation.
Which brings us to one final really important question to consider today. Are you going to let emotional biases dictate your financial future, or are you going to trust the cold hard math of compounding and stay the course? The mechanics of building